reporting season has just wrapped up and it was a mixed bag of results for ASX listed companies. While COVID is still lingering on some impacted stocks books, inflation is now creating new challenges, although some are set to benefit. To discuss the season just ended, I'm joined by Jarden's Head of Research in Australia, Ben Gilbert. Ben, how would you describe the health of Australian listed companies right now?
I think the Australian companies are generally in pretty good shape. We've seen a situation through COVID where we've had low rates, we've had a lot of stimulus that's been put in. You've had a situation where the consumer and the broader market's been pretty well supported. And overall, I think companies are in good shape. I think the challenge is we just don't know what's coming at the moment. We're entering some uncharted territory. We've got a situation where rates are going up quickly. We've got inflation that's coming up quickly. We've got record low levels of unemployment, or close to. And there's just a lot of uncertainty as to what's to come. So I think people are probably less concerned about the rearview mirror at the moment and trying to look into the crystal ball about what's coming next.
Inflation clearly a risk for retail companies, but did that show in any of their results?
Not explicitly. We saw it in sectors like the supermarkets, where the majors will explicitly talk to inflation and actually disclose figures, both Coles and Woolworths. And we definitely saw a step up in the June quarter, and I'd expect another step up in the September quarter, another step up in the December quarter. And ultimately, we're probably going to see a situation where we see food inflation of 5% plus, maybe well above 5% if you look to some of these markets offshore, such as Europe and the US. The discretionary side of things is a little bit different. We are definitely seeing price increases, particularly in areas like white goods. And JB Hi-Fi, for instance, explicitly called out a number of suppliers coming in for sort of two sets of price increases, 5 to 10% each time. So it's definitely coming. What I think the inflation side of things is doing at the moment is it's probably clouding a little bit what some of the underlying trends are.
Higher interest rates could benefit banks. How is the financial sector faring?
Look, on paper, the banks definitely benefit from a rising rates environment, given the margins that they'll make. The offsetting factor is, which we touched on at the beginning, is the consumer. And if rates are going up, it does. It puts pressure on household cash flows and then potentially balance sheets. So the concern is what does this mean to BDD in terms of bad debt? And that's the debate that we're going through. But look, in theory, the bank should be benefiting from this.
It seems COVID could be behind most companies now, although we did still see some large losses coming from travel stocks like Qantas. Do you think that this season will be the last time we'll see evidence of the pandemic punishing some companies' balance sheets?
Hopefully. But I think we're definitely, if I look at how we're positioning and how we're thinking as a team at the moment, there's a preference that sits towards the reopeners.
Investors have seen volatility on markets this year, including the ASX. How would you rate their response to this earnings season?
People probably felt that they had a reasonable idea what was coming on the whole through this period. We were cycling lockdowns in the PCP. We know what's happening on the energy side of things. A lot of companies came out and gave trading updates leading in. So I think there was a general view that, again, looking in the rearview mirror, looking at what we've seen over the last month, that things are probably still going to be looking okay. The question was, I think, is people looking for some guidance or understanding around what's to come and how companies are positioned to that. Now, how they're positioned in terms of hedging profiles, how they're positioned in terms of investment that they've made through the last sort of 12, 18, 24 months that's de-risked some of these pieces. A whole combination trying to say, okay, well, where is the risk? Where are the opportunities? How do we play these themes? And I think to your point at the start is we've seen a lot of discussion and chat around cost. And I think on the whole, C2B inflation and some of those pressures are probably looking like they're going to be bigger. And you're seeing some of the defensive names have been knocked around a lot by that through this period. Similarly, we're also seeing things like CapEx and plans there are also getting more expensive. Again, that's created some pressure. So I think it's really thinking about, okay, well, how do we want to be positioned against this rising rate cycle? Who's actually built sort of real defendable moats that can sort of come out of this sort of situation stronger? And ultimately, who's going to be able to meet or exceed the market's earnings expectations over the next sort of 12, 24 months. And it's not an easy task at the moment, I'll say that.